Hello and welcome to a discussion on preparation of the financial statements from a given set of business decisions. So business decisions will find place in the financial statements, and the business decisions are financing decisions, investment decisions and operating decisions, and these business decisions will find place in the balance sheet, income statement and cash flow statement in the form of financial items, and the financial items are incomes, expenses, assets, liabilities and equity. And this financial statements is as per the conceptual framework for preparing the financial statements. So every business decision through the financial item will find place in the financial statement. Let us take an example to understand that. This is an example, a set of transactions of an existing and ongoing business which is in a power distribution, and their balance sheet information is given indirectly as an information. On 1st April 2010, the information about this company that they have an asset worth of 500 million, all information is in million. So we have to prepare the opening balance sheet first. So the opening balance sheet, the assets are 500 million, 10% of that in the form of cash, 0.10, 0.10, 20% of that of the total assets are in the form of the debtors, 0.20, and the balance is in the form of the fixed assets. The balance is in the form of the fixed assets. Let me remove this. So the balance is in the form of fixed assets, and these assets are financed by creditors to the extent of 20%. So let me copy this. The creditors or the supplier's credit, the creditors have financed 20%. The creditors have financed 20%, so the creditors is 0.20 of the total assets, and the balance. So let us do a working here to get the details. So the total, the balance, what is the balance of money required? Balance is 500 minus 100. And this 400 is in the form of debt and equity. So the debt and equity, the debt is 1/4, is given as 1:3, so 1/4, and equity is the balance. And equity consists of 90% of the equity is a retained profit, so therefore equity consists of 90% of that, 0.90 is 270, is a retained profit, and the balance is the capital. So balance is capital. So the capital is 300 minus 270. So this information will be used for preparing our completing the sources side of the balance sheet. So the capital is 30, the retained profit is 270, debt is 100, so the total of the sources is 500. So the opening balance sheet of this company shows assets worth of 500 million, financed by capital 30, financed by retained profit 270, debt 100, creditors 100. Now with this opening balance sheet, they started doing business, the transactions. The transactions are like this. So let us take one by one. So the transactions for this period, so they have purchased power and sold power. And in a power business, entire purchase of power will become an expense because you can't store that power. So that is an expense. Otherwise this would have been an asset. And out of that 100, you paid only 80%. So therefore, 80% of that is a cash payment. You purchased 100 million, paid 80 million. So creditors will increase to the extent of the amount not paid. So the creditors at the end of the period will be equal to 100 plus 100 minus 80. That will be the closing creditor. And your sold power, which is an income for the period, is 300 million. And though you sold 300, you are able to collect only 90% of that sales. So let me take that here. So 90% of that, okay, so let me reduce the size of this. So 90% of it is the collection. 90% of the billing becomes the collection. 90% of the, so your of this sales you're only collecting 0.90, and if the sales is collection is 90, 270, but sales is 300, so your debtors, just like your creditor, will increase 100 plus 300 minus 270. So the debtor will be 100 plus 300 minus 270. What do you do after that? So collection is done. You have other expenses. Okay, so other expenses for the period. The other expenses for the period is operating expense is OPEX. Let me write down that as 10% of the sales. So 10% of 0.10. And let us assume that entire OPEX is paid, is of course is also given like that. Okay, OPEX. And another information is given that from the old debtors you collected 20. So from old debtors you collected 20. So your debtors will reduce to the extent of 20. We can see the debtors once again. I'm sorry. So the debtors will reduce to the extent of 20. So the debtors will reduce. Opening debtors 100, sales 300, minus 270 is a collection from the current billing and correction from the old billing. Then after that, there is a depreciation. There is a depreciation of 15% and tax of 30%. Depreciation of 15% and tax of 30%. Let us first handle depreciation. When I say depreciation is on the fixed assets. So depreciation is 0.15, and depreciation is not a cash item, but depreciation will reduce the value of the asset. And even if it is not given, interest has to be shown as an accrual basis, and interest is given as 10%. And let us assume that interest you are paying fully, so no outstanding interest. If all the items are taken care, so the expenses total, let us do the total of that, and incomes are 300. So profit before tax is 300 minus 192, and on that you pay the tax is 0.30, and let us assume that you pay the tax fully during that period. What to do with this PAT? If no information is given, profit after tax will be fully retained, so I increase the retained profit. And now let us find the cash balance. There was a cash in the beginning, so the total cash available is 340, and made payment during the period is 152. So 187 is a cash at the end of the period. 187 is a cash. During the period, no change in the capital, no change in the debt, so the debt and capital remain same. So the balance sheet tallies now. To recap, I said that the financial items will business decision will appear on the financial statement through the financial item. And with this example, we saw an opening balance sheet, the transactions given, and these transactions were converted into financial statement, and the business decisions appearing in the financial statement in the form of this financial item: incomes, expenses, assets, the liabilities, and the equity. And the cash flows are the receipts and payment of these incomes and expenses, the assets and liabilities. So to recap and close, the business decisions will appear in the financial statement in the form of financial items.